Where are you boys headed?
Canada? We're going over the border to Canada for some french fries and gravy, sir.
Poutine.
Dealing with paperwork before immigrating sucks. But luckily, buying property as a foreign national is relatively easier in Canada. Here are 3 basic steps to follow as you get a mortgage for your new home. Before we begin, remember to hit like and subscribe because we've got the property information you need. Step 1. Get qualified. The first thing you need is a Canadian bank account. The second thing you need is a work permit. Watch this immigration video we made to find exactly what it is and how to get it. The lender will require a letter from your employer to confirm a stable income, especially if you have had the job for less than 2 years. Here's bonus tip number 1. Once settled at your new job, start saving. The more you save, the more qualified you'll be for a mortgage, especially if you're aiming for a lowest down payment possible. Additionally, any debt you have affects your ability to borrow, so make sure to include all your liabilities in your mortgage application. That brings us to bonus tip number 2. Start working on your credit score right when you get off the plane to help yourself get a better lending rate. A good credit rating can be achieved by paying your bills on time, using and paying off credit cards, and vetting your credit reference reports frequently for errors. Here's what else you need. Once you're prepared, you can move on to step 2. Step 2. Choose your mortgage. Let's begin by covering the basics. A monthly mortgage payment is equal to principal amount and interest. A mortgage term is the amount of time your mortgage contract lasts, which is usually 5 years, after which you can renew with the same lender or remortgage with a new one. Mortgage rates are based on the prime rate, which is the interest rate set by commercial banks. The Canadian prime rate as of this video stands at 2.7%. So what type of mortgage should you go for? Let's first break down 2 common mortgage categories. Number 1, open mortgages. With this type, you can apply for early repayment at any point in time, allowing you to pay off the loan faster and thereby saving you interest costs over the life of the loan.
Can't be right. I went over those numbers 3 times.
The downside is that open mortgages are accompanied by higher interest rates so that lenders can compensate for the loss of expected interest income. Number 2, closed mortgages. You might be more familiar with this category. With closed mortgage, you cannot pay off or refinance before the end of the term without paying a penalty fee. This once again protects lenders from losing interest income. The upside here is that closed mortgages offer lower interest rates and give you a fixed repayment schedule. Now, you may be wondering, which should I choose? The answer depends entirely on your financial profile and priorities. Most middle-income borrowers prefer lower rates and would go for a closed mortgage. Now, let's take a closer look at interest rates. There are 2 main types to note. Fixed interest rate. The interest rate does not change during the mortgage term. Variable interest rate. The interest rate fluctuates according to the prime rate. Here you have 2 further options. Adjustable payments. The monthly principal payment remains the same, but interest payment varies. Fixed payment. Your total monthly payment remains the same, but if the interest rate goes up, you pay more towards the interest and less towards the principal. If the interest rate goes down, you pay less towards the interest and more towards the principal. So, what are the pros and cons? Simply put, fixed interest rates are more stable, but the rates are higher, and the penalty for early repayment is also much more costly. On the other hand, variable interest rates are less stable and more unpredictable, but the rates are lower, and the penalty for early repayment isn't as harsh. Fixed interest rates are the most popular option, but you have to think about your own individual situation. The final section of this step is understanding mortgage insurance.
What?
Here, let me explain. In Canada, 20% is considered the benchmark for down payments. However, if you're aiming to buy a property valued below 1 million Canadian, you can find mortgages offered at 10 or even 5% down payments. And that's where mortgage default insurance comes in. Since the lender has to bear a higher risk by giving out a bigger loan, they require you to get an insurance so they can protect themselves if you default in the future. Step 3. Research lenders. In Canada, there are 3 main types of lenders. A lenders are typically mainstream institutions that require a comprehensive credit history and a high credit score. But you can always hunt for other options amongst alternative and private lenders. Remember to do your due diligence when selecting the institution you'd like to borrow from. Many immigrants are qualified for mortgages every day. To be exact, 80% of mortgage consumers are newcomers to Canada. Long as you plan ahead and research diligently, things will pan out smoothly. For more Canadian real estate information and overseas investment opportunities, sign up to our newsletter and follow our social media pages.